Welcome to the deep dive. Today we're not just, reading market commentary. You're cracking open a stack of sources that feel less like academic texts and more like, well, like genuine financial crystal balls. We're going to dive deep into these books, the true oracles that didn't just analyze history, they give us the frameworks to actually predict the future. We're talking market crashes, tech upheavals, and staggering inequality.
Exactly.
Our mission here is really for you, to quickly pull out the most important nuggets from these prophetic texts. We want to get at the intellectual DNA of foresight, that handful of concepts that foresaw everything from the 1929 crash all the way to the crypto revolution.
And if you look closely, these authors, even writing decades apart, they're all circling around three core themes.
Okay.
First, there's the danger of just unchecked speculation, the human desire to get rich quick. Second, the fragility of systems that are built on too much leverage, too much debt. And third, and this is a big one, our inescapable tendency toward overconfidence and just total historical amnesia.
Forgetting the last crisis.
Forgetting every last crisis.
Yeah.
And understanding these patterns is so relevant right now, sitting here in late 2025. I mean, you're navigating a landscape of AI-driven innovation, stubborn inflation, crypto volatility, geopolitical tension. The warnings from these oracles are not dusty history. They are a direct guide to right now.
Okay, let's unpack this with, I guess, the granddaddy of them all.
Mm-hmm.
John Kenneth Galbraith's 1955 classic, The Great Crash, 1929.
Mm-hmm.
And while he was analyzing something that had already happened, his work became the undisputed blueprint for predicting future bubbles. They called him the Oracle of Oz, right? Because he pulled back the curtain.
He showed the wizard was just a man.
Exactly.
Mm.
I think the genius of Galbraith wasn't just spotting the bubble, but detailing how the mechanics of the market were just specifically designed to collapse. What was his core insight about speculation?
Well, his core warning was that these speculative orgies, they detach entirely from fundamentals. They create what he called a sort of consensus escape into make-believe.
A shared delusion.
Precisely. And he traced it to a cultural shift in the 1920s where the American middle class suddenly embraced this idea of effortless wealth. The Florida land boom, which was basically a real estate Ponzi scheme, that helped instill this false belief that prosperity was just inevitable.
And you can see it in the numbers.
Oh, absolutely. The data shows this acceleration of irrationality. Stock prices soared from an index of 106 to 181 just between May 1924 and December 1925. Then it gets turbocharged in 27 when the Fed cut the rediscount rate, pumping in liquidity that just flowed straight into speculative loans.
But the real kicker, the actual mechanism of destruction.
Yeah.
It wasn't just optimism, right? It was the structural fragility of the whole system.
Absolutely. The critical mechanism Galbraith identified, the thing that amplified risk beyond anything stable, was widespread margin buying.
So people borrowing heavily to buy stocks.
Right. Borrowing from brokers, using those same stocks as collateral. In a stable market, that's fine. It speeds up growth. But in a manic market, it creates systemic instability. Everyone is tethered to the same volatile asset.
And the numbers on those loans are they're staggering.
They are. Margin loans or brokers' loans. They ballooned from about maybe $1.5 billion in the early 20s to a frightening $6 billion by November 1928.
Wow.
And think about the risk appetite. These loans had interest rates as high as 12%, and people were still piling in, convinced the stock returns would easily outpace the cost of borrowing.
That is the ultimate leverage trap. You get the benefits of ownership without paying in full, but one dip in the market triggers margin calls, forcing sales, which pushes the market down further, triggering more margin calls. It's a devastating domino effect.
And Galbraith showed this was made worse by two other factors. He pointed to the leveraged corporate pyramids, these holding companies that just built debt on top of debt, and the weak decentralized banking system, which was prone to these domino failures.
The outcome, of course, was the crash, leading straight to the Great Depression. Unemployment hits 25%, GDP is cut in half. But of all the weaknesses Galbraith found, the one that keeps coming back is the massive income inequality.
That's the part that makes the system so brittle. He noted that the top 5% of the population claimed 1/3 of the entire national income.
A third.
So when income is that concentrated, the demand side of the economy, the ability of the average person to spend and absorb shocks, it just evaporates in a downturn. Most people had no buffer. That's what turns a market crash into a total economic collapse.
So the timeless lesson from Galbraith, it's that fading memories of crashes lead right back to the conditions that caused them.
Precisely. If Galbraith showed us the structural flaw, now we need to shift to the psychological one.
Speaking of psychology, let's jump forward to Robert J. Schiller's Irrational Exuberance, first published in 2000, right in the middle of the dot-com frenzy.
Perfect timing.
He used behavioral economics to forecast a downturn when everyone else was saying economic cycles were a thing of the past.
Schiller's genius was combining those psychological insights with a really powerful historical metric. His key prediction for poor long-term returns. It was all based on the cyclically adjusted price-to-earnings ratio, the key PE ratio.
And in 2000, that ratio was at an all-time high.
Unprecedented highs. It was screaming overvaluation.
For listeners who know the standard PE ratio, why is KP the better oracle?
That's a great question. A standard PE looks at just 1 year of earnings, so it's easily distorted by, the madness of the market cycle, a temporary profit spike or dip.
Okay.
The CPE ratio, though, it smooths out that volatility. It uses the average inflation-adjusted earnings from the past 10 years, so it tells you if prices are just high today or if they're truly high for the whole decade. When KPE hits extremes, Schiller argued, you're heading for pain.
And he didn't stop at stocks. The 2005 edition of the book specifically called out the housing bubble.
He did. He noted that prices in hotspots were 6 to 9 times the median income, which was it was drastically outside historical norms.
And the rationale is always the same thing he calls irrational exuberance.
It's that dangerous feedback loop. Herd mentality, FOMO, media hype. It all detaches prices from fundamentals. People just ignored the basic history. That real home returns were consistently under 1% a year after inflation. They preferred the narrative of this time is different.
And the outcomes proved him right twice. The NASDAQ dropped over 80% by 2002, and then the housing bubble burst in 07-08, triggering the Great Recession.
So Schiller focused on the predictable psychological flaws. Nassim Nicholas Taleb focused on the unpredictable dangers lurking outside our models.
With The Black Swan, published in 2007, talk about timing, right before the 2008 meltdown.
Incredible.
He introduced this idea of black swans, these rare, high-impact events that our financial models just fatally underestimate. But wait, doesn't that concept sort of excuse any predictive error? If it's fundamentally unpredictable, how can we prepare?
That's the crucial question. Taleb doesn't say events are impossible to foresee. He says they are impossible to model accurately with traditional statistics. He argued finance operates in what he calls extremistan, a world dominated by outliers.
Not the neat, predictable world of mediocrism.
Exactly. And our own biases, like the narrative fallacy, they blind us to these tail risks. We believe our models capture reality when they don't. So his prediction wasn't what would fail, but that the system was engineered for catastrophic vulnerability. He advocated for building anti-fragility.
Anti-fragility, the idea of not just surviving a shock, but actually benefiting from it. How do you do that if the risk is unknowable?
He suggests the barbell strategy. So instead of putting your money in moderate risk assets, you put, say, 90% in ultra-safe treasury bonds. That guarantees stability. And the other 10% in moonshot, high-risk things like venture capital or volatile crypto.
So you protect your core, but you have exposure to massive upside.
You protect your core from shocks, and you benefit disproportionately if a rare event happens. It's an insurance policy against the unknown.
In 2008, COVID-19, the 2022 market shifts. They all validated this danger of black swan exposure. Taleb's framework feels especially relevant now, with geopolitical risks and cyber threats that just don't fit into traditional models.
Which brings us from the behavioral warnings to the structural warnings committed by governments over centuries.
And to Reinhardt and Rogoff's massive historical analysis, this time is different from 2009. 800 years of financial history to prove that this time is different are the most expensive words in the English language.
Their central prediction was stark. Sovereign defaults and economic stagnation become highly likely when a nation's debt gets above a threshold of, say, 60 to 90% of GNP. The core rationale is that governments have the same historical amnesia as investors. They always think they can handle more debt without consequence until the bust.
And we saw that play out immediately post-2008. U.S. debt surged past that threshold. Europe had its sovereign debt crises, Greece in 2010, and growth just lagged for years. And it's so crucial now, with global debt at record highs post-COVID.
We also have to talk about wealth concentration, which leads us to Thomas Piketty's Capital in the 21st Century from 2013.
Ah, yes, Piketty's Feynman formula, RGY. Tell us what that dynamic predicts.
His prediction was that surging inequality, what he calls patrimonial capitalism, where inherited wealth dominates earned income. It happens when the rate of return on capital R is consistently greater than the rate of economic growth.
Gee, so if your money makes money faster than the economy is growing, The rich just automatically pull away from everyone else.
Inherently, yes, and we are seeing it clearly. The U.S. top 1% wealth share is at about 35% as of 2025. That's up from 20% in 1980. And this isn't just an ethical issue, it's an economic vulnerability, just like Galbraith saw in 1929.
And you have to factor in AI automation today. If AI suppresses wages, that pushes growth, G, down for many people, while the capital of asset owners, R, keeps soaring. That can make the RG dynamic even worse, fueling social unrest and populism.
Exactly. And speaking of responses, we should briefly mention Paul Krugman. His book, The Return of Depression Economics, warned that deregulation and global imbalances were creating a vulnerability to, well, to old-fashioned depression risks, specifically the liquidity trap.
The liquidity trap. That's when interest rates are near zero, but no one will borrow or spend, so monetary policy is useless.
That's it. The central bank runs out of ammunition. Krugman was an early advocate for aggressive fiscal stimulus government spending to break that cycle, and the massive bailouts and quantitative easing post-2008 were a direct validation of his framework.
Okay, let's shift to the New Frontiers authors who predicted technological and geopolitical disruption, starting with an incredibly prescient book from 1997, The Sovereign Individual.
This was written before most of us had dial-up, yet their key prediction was that a digital economy would fundamentally upend state power. They specifically foresaw the rise of cyber money
Cyber money.
as a revolutionary force, empowering individuals, protecting wealth through cryptography, and eroding the power of fiat currency and central banks.
And the outcome. Bitcoin emerges in 2009, leading to a $2 trillion plus crypto market. It's the perfect embodiment of their vision.
We also have to link global conflict to economic instability. George Friedman's The Next 100 Years did exactly that. He tied economic disruption directly to long-term geopolitical rivalries. He made a very specific and unnerving prediction:
Which was?
the Russia-Ukraine war by the 2020s and persistent U.S.-China rivalry affecting global trade.
Horrifyingly accurate. The 2022 invasion spiked energy prices, and the ongoing China trade tensions affect everything. It's a reminder that no financial plan exists in a vacuum.
And to synthesize all these converging threats, we have to look at the most recent oracle, Nouriel Roubini's 2022 book, Megathreats. His framework isn't about a single crisis. It's about a convergence of 10 interconnected crises: debt, stagflation, deglobalization, climate shocks. He cites this compounding effect. Global debt, over 350% of GDP, meets rapid AI automation that could displace 50% of jobs. He argues these threats wipe out the tools we normally use to fight a recession.
So before we wrap, we have to bring back the foundational framework that unites all of this, from Charles P. Kindleberger's Manias, Panics, and Crashes. He formalized Hyman Minsky's financial instability hypothesis.
And Minsky's hypothesis is fascinating. It says stability creates instability. Long periods of calm encourage investors to take on more risk, more leverage, moving from cautious finance to speculative, Ponzi-style finance.
So good times create the seeds of their own destruction.
Exactly. And Kindleberger showed that bubbles burst when credit inevitably tightens, and there's no lender of last resort to stop the contagion. It's the ultimate predictable pattern, and we've seen it validated in 1987, 2000, 2008. It's the essential lens for watching credit cycles today.
So we've covered a huge amount of ground here. We've connected Galbraith's mechanics to Shiller's psychology, Piketty's structure to Taleb's tail risks. And what's clear is that markets, they aren't random.
Not at all. The entire journey shows that the cycle always revolves around those three themes: reckless speculation, fragile leverage, and above all, human amnesia.
So the final actionable lessons for you, synthesized from all these sources, are pretty clear.
They are. You have to build resilience into your strategies. You have to ruthlessly question hype, especially in new sectors. You have to heed historical data like the CPE ratio and debt levels. And you must diversify for both the predictable cycles and the unpredictable black swans.
Which brings us to the final provocative thought for you to chew on, built on this whole history of systemic amnesia. Given that we repeatedly ignore the historical warnings about debt and speculation, from Galbraith to Reinhardt and Rogoff, is the greatest financial risk today not the next unknowable black swan that Taleb warned us about, but rather our fundamental inability to act rationally on the predictable consequences of the known megathreats Roubini has laid out for us. Think about that as you weigh your next investment decision.